Welcome back to another episode of BullRush Academy, where we cover the basics of trading to help you improve your skill set to become a better trader. This week, we're going to cover candlesticks. Not a lot of people know that candlesticks are the most popular chart type. You have bar charts, you have line charts, you have candlestick, and a host of others, but candlesticks are by far and away the most popular out there. So let's cover the basics of the candlestick charts. First, let's just dive into a little bit of history. The candlesticks were first developed in the 18th century by Japanese rice trader Munisha Hama. Similar to the Fibonacci sequence that we covered last week, not a lot of people knew about it, especially in Western civilization, for a long period after that. It was initially Charles Dow who tried to bring it into Western civilization. However, he completely failed. He didn't have the right delivery message. Not a lot of people understood what it was. Nothing went on in Western civilization for the next 100+ years. Fast forward 100 years later, and then you have a person by the name of Steve Nissen, who wrote a book titled Japanese Candlesticks. He wrote this book in 1991. That was really when it started taking off in Western civilization. A ton of traders started utilizing Japanese candlesticks. Prior to that, they were either using bar charts or they were using line graphs, but those have a lot of deficiencies in them and are not quite as useful, in my opinion, as Japanese candlesticks. You get price action in there. You get an easy visualization to see whether a price moved up or down. You can understand exactly how that time period traded just strictly based off of the candlestick. So let's dive into the parts of a candlestick. You have the open, you have the high, you have the low, and you have the close. All of those are very important when you are talking about candlesticks. In addition to that, you have the body and you have the wicks. The body is typically filled in with colors. If it's moving up, you'll typically see a green or black color, or if it's moving down, you'll simply see a white or red color. Those are generally speaking the colors that most traders use. However, most charting softwares these days allow you to change the colors to whatever you want. Before we dive into the full video, just want to tell a quick story that dovetails perfectly into this video. When I first got plucked out of college to be a professional trader, I was hired by a large institutional trading firm in Chicago where I was taught to trade. Part of their training process was they did not allow us to use charts. No charts at all. You had to look at a depth of market, or DOM as it's often referred to, or ladder. And how they taught you was you would sit there and you would just watch, and you'd watch to see how the prices moved around certain periods of time. And the idea was you started getting a good feel of the market and you would be able to make better decisions based on that. And you really got in tune with it. Thankfully, these days we have candlestick charts that allow you to easily identify price action, reversals. You can see exactly how the market traded, and not to mention in real time, but also historical reference as well. And that has really greatly improved a lot of people's ability to go learn trading, because they're not having to sit in front of screens 24/7 like I did, where my average trading day was 12 hours. Now you can jump in and out because you have a historical reference, and candlesticks have really helped with that. So with that, let's get into the video. Now that we have the charts pulled up, let's just cover some of the things that we just did. The first is the parts of the candlestick. You have the open and the close, which forms the body. So this big large part right here is the body. Typically speaking, this will be filled in if it's negative in red and if it's positive in green, like it's on my chart now. Most charting platforms these days allow you to change the color. So if you don't like red or green and you have a different color preference, use what you want. It doesn't really matter as long as you can easily identify the chart that you're looking at. The other part and sections of a candlestick are what's called the wicks. The wicks are formed by the high and the low. And so putting all those together, you have the open, close, high, and low all formed in a single candlestick. And those are how you can start to piece those together in order to help identify different patterns and things like that to improve your trading. Again, a big reason why a lot of traders use candlesticks is because you can see a good price action. You can see really what the market was doing around that time of that period. So for mine, I'm using a daily Bitcoin chart, but you can use whatever time frame or whatever product you want to trade, whether it's FX, whether it's futures, whether it's crypto, whether it's stocks. It doesn't matter. This type of a technical analysis applies to any trading. In this video, we're just going to cover some of the basics and sort of what to look for. So if I scroll over here, we can see see what things go on. And a good example of a doji as one of the technical candlestick patterns here is a trend reversal. And that's something really important with candlesticks, is it helps to identify trend reversals and where the market may head to once that occurs. And so you can see here, we had a lot of downward pressure. That's indicated by these larger red bodies. That's really important, is when you're looking at this, the larger the body in a single direction, the stronger the movement is and the more emphasis that you should put on that. And so we had a bunch of downward movement. And then you see here, this candle that I'm looking at, you can see it initially opened, it pushed down pretty far, and then came back and closed with a small body, but a very large wick. What this is showing you is that the price action was there. We had buyers stepping into the market because they no longer thought it was going to continue down. And so typically speaking, when you see a lot of big wicks like this after a downward movement, you should expect a reversal in the markets, which is exactly what happened here. We have 3 down bars and goes into the fourth. Then you see buyers step in, push it up, and we have a little sideways before it starts back on the upward trend. And then you can see the exact opposite happen here, where once it starts stabilizing, and then every time it tries to go on that trajectory, you see it getting pushed down, and that's indicated by these large wicks. And then it pushes down, and you see the downward movement again, followed by a large wick, which then pushes it back up. And so again, trend reversals and price action are 2 of the big benefits that candlesticks provide that a line chart doesn't provide you when you're trying to trade. And so it's really important to understand that and be able to quickly identify the different movements in the market. With just that one bit of information, you can really improve your trading. Going back over the wicks, and the larger the wick, the larger the rejection of that area. It means there are buyers or sellers coming in that don't want the price to keep going, and so they're willing to come in and buy. All markets are made up of buyers and sellers to find the equilibrium. That's ultimately what trading is. It's trying to find the equilibrium and what the fair value of any asset or product is. In this situation, larger the wick, the more that the market and traders do not want the price to continue, and so you should expect a reversal in the other direction. Larger the body, on the other hand, an indicator that the market will continue in that direction. And so you can see here, small body, big body, you should expect in most scenarios for the market to continue. It's important to note that that's not always the case. That's why traders are there. Not every one of these chart patterns will hold true every single time. There are indicators that don't. For example, here's a great one. It gets rejected, and then moves sideways, and then still does move down. And in this situation, most people would have gotten stopped out. So you still have to pay attention. Not any one single indicator is the holy grail. You still have to understand how the market is moving in a given time. Candlesticks are just really helpful to identify that quickly. And that's a big goal of candlesticks, is to be able to easily identify what's going on in the market without having to manually sit there and see what's going on and try to guess and second guess yourself. The goal of candlesticks is to have a few key candlesticks that you can look at and quickly be able to identify what's going on in the market. I can see in this candlestick, if you look at these couple right here as a great example, I can see that based on the large bodies that the market starts moving down pretty aggressively. There's a lot of sellers in the market here. Big bodies down, big bodies down, big bodies down. All of a sudden, there's a big wick and it closes out, and that means there's a big rejection. So as soon as that candle closed, I would be looking to start buying into this market, because I've seen a big market movement down followed by a big rejection where a lot of buyers stepped in, and the market starts moving back up. And I would be looking to start buying on this candle here. It's important to let the candle close. I see so many traders jump into the market early where, if they're doing a daily and there's a few hours left in the day, they make a guess and they're like, hey, I'm going to go and jump in this market early and start doing it just for some news event or some fundamental announcement to come out or something to change. And then all of a sudden, that's an invalidated candle and it no longer is relevant, and it costs them ultimately money and profits. And so it's important. Don't try to predict and make early judgment calls. Wait for that candle to fully close before you put on a trade. And so in this example here, I would wait till this candle closed, and then I would be looking to get in on this daily on this August 6th. So August 5th completely closes. August 5th is when I would put my trade on. And in this situation, I would have put my trade on here on roughly, 53,900, 54,000, somewhere in that range for the upward movement. And then you can see here, in this situation, it did have a big validation candle 2 days later with a big movement. So that would have confirmed that I believe this market's going to go up. And so I would have stayed in that trade for that duration. And then you can see here, it starts getting rejected a little bit. Every time it goes up, it's getting rejected. And then you can see these candles here, which we'll cover in a later video. There's a ton of candlestick chart patterns that you can go and try to recognize to help improve your trading. There's over 100 of them. In this video, we're just covering the basics, but in that video, we're going to go into what each one of these means and what you should be looking for. That concludes another video here at BullRush Academy. We hope you enjoyed it. Make sure to stay tuned, as this video was just set to cover the basics of the candlestick patterns, but we are going to go into the different types of candlestick setups in the next ones, the dojis, the shooting stars. There's over 100 of different types of patterns that you can learn and help you apply them to your technical analysis to improve your skill sets. We're going to cover those in a later video. But for right now, and make sure you're getting notified, make sure to smash that like button, hit the notifications, and make sure you subscribe.